Hello everyone and welcome to the NinjaTrader Ecosystem webinar room. My name is Toni Hansen and I work for NinjaTrader in our Denver office. We have a very special event for you today with Toni Hansen. I'd like to mention that it is important to understand that there are substantial risks in trading commodity future contracts in Forex. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstances and financial resources. It is possible to lose all funds deposited with your broker and even incur losses beyond these amounts. Please inquire at the link provided for more information or for the copy of the CFTC full risk disclosure. Also, please remember that these training webinars are not a solicitation nor a recommendation, but simply education in nature. This presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to NinjaTrader Brokerage directly at the information provided. With new tools added nearly every day, NinjaTrader Ecosystem is home to hundreds of apps and services. You can quickly and easily find the tools or services you're looking for with simple keyword search. You'll also find information about upcoming webinars in an on-demand video archive to view event recordings at the link provided. Also, if you are active on social media, please ensure to like or follow us all for the best way to get updates on all things NinjaTrader Ecosystem. NinjaTrader is always free for advanced charting, strategy backtesting, and trade simulation. To ensure you are on the latest version of NinjaTrader and pick up a free live data trial, please visit the following link. And if you are just getting started with NinjaTrader, we offer free live training on a daily basis. You can view a schedule of weekly webinars at the following link. We are very excited for this unique event in which Toni will demonstrate how to improve trade management with micro E-mini features. Thanks again for your attendance today, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room, Toni. Please take it away, Toni.
Hello, everyone. Thank you, Tiffany, for having me here today. So today we're going to talk about trade management using the micro E-mini index futures. So how many of you have tried out the micros yet? Yes, we got some no's in here too. Okay, cool. Well, I'm going to tell you a little bit about the micros, and I'm also going to give you hopefully some great education on looking at strategies and how to use the micros to improve your trade management using traditional strategies. So you guys, we're often exposed to the markets with really core strategies, things like cup with handle, head and shoulders, patterns like that. These are what most traders first come into the markets, they first start to learn about, but we don't get into a lot of detail on that. So in today's class, we're going to talk about details on traditional strategies, and I'm going to show you differences in how I approach those traditional strategies and how the micros can help you improve your trade management on those strategies. So to start with, I want to tell you just a little bit about the micro E-mini index futures. So these came out on May 6th, right at a month ago. I started trading them as soon as they came out. I was pleasantly surprised with how much liquidity we had. It was really easy to get fills on the trades, got some nice price movements. So when you're looking at trading the micro E-minis compared to typical E-mini index futures, here's what we're looking at. If you have one contract on the micro ES, you're going to be looking at the trading symbol MES, M for micro, and then ES is our S&P 500. So if you're trading one contract, moves 1 point, you've got a $5 move in the micro. If you're looking at it on the regular E-mini, you're looking at a $50 move just for 1 point with one contract. Obviously, this puts the E-minis out of range for a lot of individual traders, especially new traders, and because you will have such a large stop on a lot of the traditional strategies. Jeff here is saying he used to trade the big one, $500 a point. when I first started trading is when the E-minis were first introduced back in the mid-1990s. And at the time, they were a huge thing. Of course, over the years, the indices have continued to rally, so it's gotten even more difficult for new traders to get involved. When you're looking at the NASDAQ 100, the micro is the MNQ. That's the symbol for your micro NQ. NQ, of course, is the NASDAQ. Here's a, looks like I've got things flipped around here. The Dow Jones is actually the MYM. Thought we fixed this slide here, so flip these two around. Sorry about that, you guys. I was doing edits last night and I missed this one. So here is the Russell is actually M2K. So Russell is M2K and the Dow is the MYM. And the rest of this data here needs flipped here too. Let me go ahead and show you this. I'm going to fix this here for you. So we've got MYM and M2K. And here's the YM, and here's the Russell, RTY. All right, so you can see when you're looking at the E-minis, you've got a pretty big difference between your micros and your regular E-minis. I'll have to have them fix that in the slides when we go forward here. But let's go on and take a look at how this actually impacts the overall market when we're looking at traditional strategies. So here is a chart of a typical pattern you guys are probably familiar with. It is the cup with handle. So how many of you guys have seen a cup with handle? How many of you are familiar with this pattern? It's just a typical traditional trading strategy. It's one of the very first ones most traders, if you're coming in from like a technical background, it's one of the first ones that you're exposed to. So there's two ways that people are traditionally taught to trade a cup with handle pattern. So the first way that they are taught to trade this is to look for a break in the handle. So your cup is the rounded part, your handle is the pullback. Now, what you're going to see me talk about throughout the class is two-wave price development. So I'm often focusing on things like two-wave corrections, two-wave continuations. So when we have a cup with handle, ideally you'll have a nice two-wave pullback in this handle. Typical buy trigger is over the handle itself. Basically, you're connecting your first high and your second high within the handle. So if you're looking at this as the typical trigger, you're going to be looking for a buy at 75.56. This is on the NQ. So when you're looking at the NQ, you guys are asking questions. I know we've got a lot of questions. I'm going to pull those up at the end of the session. So I will give you plenty of time to ask questions at the end of the session. So if I miss something, don't worry about it. I'll come back to it. Okay, so when we're looking at a traditional buy on the cup with handle, you're going to be looking at this breakout on the NQ. This is a trade that I had a couple of weeks ago, and the traditional trigger would be at 75.56 over this handle breakout. Now, when we're looking at the NQ, if you just have one contract, traditional target level is taught to go for a measured move where you are looking at the upside off of the low of the cup and then a measured move coming out of the handle. So you're basically looking for A to equal B. Now, the problem with this is that if you take that traditional entry, you've got a potential target of about $580 versus a potential stop of more than $620 because your stop is going to be under the low of that handle. So your return compared to what your risk is actually less than 1-to-1. This is how most traders are taught a cup with handle pattern. Another way that you will see it taught is to take a buy over the high of the handle and then look for a measured move, again, the upside swing, but then a measured move coming out of that high. So A, again, equaling B. Problem with this, again, of course, is this doesn't work very well. Your return compared to what your risk is just isn't that great. You'd have a potential target of 1,230 with one contract on the NQ, but your stop would be over $870. What you'll notice is this didn't even hit that measured move. It didn't hit that full target level. In reality, it pulled back, it took out the stop. So if you had just done like a do or die type of pattern on these, a lot of people that will teach you technical analysis, they'll say, oh, it's okay, this pattern is successful 70% of the time, 80% of the time. You know, just set it and forget it. Go for do or die. You're either going to take the target or you're going to take a stop. I don't like that advice. I want you guys to have the best opportunity to succeed on the strategies. I don't like the odds of where I'm just going to sit there and wait and hope it either hits the target or I'm going to take a stop. Exactly, Dean says, poof, there goes your account if you did that. Let's look at some different ways of approaching the market. So I'm going to show you the same thing here, but we're going to drop down to the MNQ. So this is the micro NQ this time around. Same look at the patterns. Here's the first way I showed you guys to enter it. The difference is your potential gain here is 25 points, about the same amount of points, but you've got 375 as your target level. But your stop is still $465. Now, I'm using 3 contracts here. And you'll notice when I talked about the NQ, I was only talking about 1 contract. You're going to understand why here as we go forward. Because when we look at managing trades, when you have the opportunity to take a larger position, whether it's more contracts or more shares, you have the greater potential to manage a trade. So even if things don't work out as you're anticipating when you're going into the trade, you can still come out of the trade without a loss, even if it ends up and going and ultimately stopping out. I'm going to show you guys exactly how I do that as we go forward. First, here's the traditional way again. Here's an uh-oh point. A lot of times people move their stops to break even when they take a breakout. Let's just say that's a horrible plan. That's another horrible plan. Don't do that. If you take a breakout of a handle, if you get, let's say, you got your new high here, a lot of people will say, I don't want to take a loss on this trade anymore. Moving your stop to break even is basically putting your stop right at a support level. So you're getting out of a trade right at the very level that it's probably going to bounce. So bad idea. Don't do it. Here is how this looks when you look at the MNQ. Again, pretty big difference compared to what you're expecting versus what you're risking, but it's still pretty sizable amount. When we go forward, though, I want you guys to look at this a little bit differently. So most of these handles are going to have a two-wave correction. That's what I want to look for when I'm looking for the handle with a cup with handle. And within that, you will often find that the market loves to work in waves of 2. So in this handle, the second part of this handle, there's actually 2 more smaller corrective moves. So the way that I teach my traders to take a cup with handle strategy is to use a channel break of that second pullback within the handle. So you actually are getting a return compared to what you risk that is twice what it would be with both of those 2 traditional setups. Again, those 2 traditional setups are the ways you're going to find taught in most books, most websites. I came across a post on Instagram the other day where people were drawing out all of these patterns like cup of handles and head and shoulders. I basically went and crossed them out and said, here, I fixed it, because we're looking at these smaller moves to help you get into the trade. Now, what this does is that your return compared to what you're risking has now doubled, but your chance of getting stopped out has not changed substantially. So your odds of getting stopped out, whether you take this breakout here or whether you take the entry here, are about the same. There's not much difference in whether or not this one will work versus this one. The difference is that you've got substantially more profit to play with when you are going in at that tighter level. We're going to look at this even further. So now you've got $575 target versus $255 stop. And again, this is just based on that one-to-one return to reward. As you guys saw, this actually went further. So your potential was really much greater than that, but if you take traditional exits, you're only looking for one-to-one. We're going to look for more. So here we go down into even greater detail on the handle. Here's the handle. Here's the second wave. And look at that. Another two-wave measured move. This isn't something that just happened on this trade. In fact, I had a deadline to get this presentation turned into NinjaTrader to do their compliance. This is a trade that I took that very day that I made the presentation. So this is something that is happening pretty much every day in the markets. It doesn't matter whether you're trading the micros, doesn't matter if you're trading Forex, if you're an options trader, you're going to come across this concept over and over again, where if the momentum on a move is comparable to a previous move, you can look for a measured move target. So we have a number of them all coming together right at this same spot on this trade. We have the larger two-wave move, we've got the smaller two-wave move, and then we have a smaller one even still. So traditionally, I teach my traders to use this channel break as an entry. But as they get into more advanced levels of trading, they're actually using the pivot levels here, where they drop down to even those smaller measured move levels. So they're looking at a confluence of all of these support levels coming together, like the 76.4% retracement here, and those measured moves to help get them into the trade, but then using the same idea, the channel break. So here was the last level I showed you guys. Here's the one that's a traditional entry, and here's the honed entry using the smaller two-wave move. So at this point, you've now got an entry at 75.30 compared to a stop 75.25, under 75.25. You've got a 5-point stop here. That's it. So this is a big difference compared to what you were expecting as a target level versus what you're risking as a stop. It makes a huge difference. This doesn't tell you why we're looking at 3 contracts though. Why would I trade 3 contracts? Anyone have an idea? Why trade 3 contracts? Why can't I just practice with 1 contract and just look for a pure target level? You want to scale out, you want to add into runners, get out at 3 targets. All of these are good points. Also, it protects you if something goes wrong. So if things turn around, for example, if a strategy fails, you've got 1 contract on the NQ. You're basically either hoping that target's going to hit, or you're going to take a stop, or you're going to use some sort of trailing stop that's going to end up giving back a lot of your gains. With 3 contracts, though, you can adjust your trade as it unfolds. So this can minimize your stop losses as well as allow for adjustments when the trend is stronger than anticipated. So on this example with the cup with handle, it goes more than the one-to-one measured impulse waves. It actually goes substantially more. And if you take just the traditional cup with handle strategies, you're doing yourself an insane disservice. Neither one of those actually made a good profit. The first one, you were risking more than you actually got on the trade when it did hit the target. And the second one, it never even hit the target and would have stopped you out if you did do or die. And I pulled both of those from very, very well-known technical analysis sites, places that teach technical analysis. They're in the core textbooks for a core cup with handle pattern. Not going to trade them. Will not trade them like that. No way, no how. When I first got into trading, I was told, hey, here's how we take these setups. But then I was like, why is one working and one's not working? There has to be a better way. And sure enough, there is. So when we're looking at 3 contracts, we can do things a little bit differently. Let's say, for example, this handle doesn't do what we are hoping it would do. So I've got my breakout. Here's the entry trigger that I used. You can also even take an entry trigger like that with that channel break. And you'll notice that as this pulls out, this channel of this breakout coming off of the lows is slower than it was back here. Now, in reality, in the actual trade, it bounced really fast. It bounced just as quickly. But if it goes slower into what would be one of those traditional trigger points, it tells me, something's not quite right here. It's just not what I want to see happening. So with 3 contracts, I am protecting a contract at that level, looking for, again, like a little measured move, looking for that resistance with the channel. So I've got $75 per contract. Now I've got 2 contracts left. Now, let's say things are still looking a little bit more dismal. It pulls back all the way back to my previous low. My original stop is here, and now momentum is shifting again. So here's 2 things you can do depending upon your skills. If you are learning this strategy pretty well, if you see this 2-wave move again, basically same time development as the initial move up here, but it's not gaining that momentum off of the low, I'm going to protect more of the trade at that point. So I would take off another contract. Now, sometimes this will manage to turn around and it will still manage to get going. Usually that's going to work best if it's hugging along the upper channel. So momentum is actually shifting. It's pulled down faster after it pulled up slower, and then it's basing. So my do or die point becomes that channel break. I'm no longer caring about what that previous low is. I'm looking at this channel. That channel breaks, that's getting me out of the rest of the trade, and a lot of times it's actually flipping my position because this now becomes 1 wave up, 2nd wave correction, and leads to a bigger breakdown. So your cup with handle can actually shift and turn into a 2-wave breakdown instead. Now that entire trade, if I traded it with a stop under the low and was just looking for a target level with just 1 contract, I would have a loss. On the other hand, with 3 contracts, I can still walk out of that trade with a gain. So compared to what the potential is with slippage, do or die method, I'm stopped out for $75 plus confirmation and slippage. That's what it would have been if I took the full stop. But by scaling out of it, I'm able to come away with, $50, $60. If anything, it's not going to be a loss. So your original level would be $100, but I'm just factoring, hey, you're going to have some slippage. You're not going to get, exact exits compared to what you want, but you can still walk away with that strategy as a gain. I tell my traders, it's very rare that I take full stops. Usually if I take a full stop, it's because I bought something and then it immediately turns against me. So I don't have time to play around with managing the trade. But the thing is, my stops are so tight because I'm basing them upon strategies like this, where even if I take that channel break, it's still a pretty tight stop. And my gain compared to that stop is pretty substantial. So even if I take a stop, a single trade more than makes up for that loss, only because I'm using these tighter techniques to get into the trade. So key with using this tighter technique is that you're going to be looking for the two-wave correction into a support level, like that 76.4% fan, or 74.6% fan rather. A lot of times, I'm sorry, that you know what, that was a Fibonacci retracement. I use fans as well. So I will put a fan on here like this, Fibonacci fan, and it'll have the 76.4% fan there as well. Let's look at this trade again though, using that new strategy that I told you guys about. So buying it into the support level here, the 76.4% retracement. Oftentimes, again, it's also usually a fan level too, but buying it into that support level, looking at target levels, I'm going back and doing that wave count method again. I'm looking for things like measured moves, and I'm looking at that original momentum move. So I'm not using the absolute high here. I'm looking at that first main momentum before the correction begins to start. Before this starts to slip over, turns into choppier type of trading. Basically, those first two smaller impulse moves, here and here, when I'm looking for two-way pullback, I'm then looking for that two-wave move to give me that measured level. So I'm going to use that to protect part of my trade. So the momentum here off the lows was stronger than the one that failed. It was nice. It was good compared to the one over here. That tells me, hey, better chance this is going to go for larger target levels. So you're looking at $240 a contract now compared to $25 contract risk. Really, really nice gain compared to what you're risking. If you go forward on this, you'll notice I used that measured move concept again. This got me out of more of the trade. If you're looking at this level, you got $395 per contract versus your $25 per stop on your contract. So big, big difference when you're looking at your gain potential compared to your stop potential just by knowing this very simple idea of looking at the smaller channel breaks and not using that entire move there or there. Those are the two that people are taught. Those are the two that are going to get you in more trouble than they are worth. So a lot of people say, oh, I hate that pattern. It doesn't work for me. It's because they're not doing it this way. Even if you use the way that I originally teach my traders, because again, getting into here is more the advanced, you're still looking at really substantial gain compared to your stop. Even if it did only a measured move, you're still looking at 2 to 1 as your target level, as your original target level. Oh, you guys, you know what? When I did my template for putting this class together, I used the ES, the $5 versus the $2. That is a good catch. So all of these are just going to be, your gains are going to be the same as far as point-wise goes, but we are looking at the NQ here versus the ES. So that's actually $2 a point versus $5 a point. Oh boy. What is my slippage on? That's a really good question. So I've tried this with up to 20 contracts, and I have not had a lot of slippage on it. After hours, I will get some. It's more slippage than on the E-minis, but it's not substantial. It's usually just a couple of ticks. So when you're looking at, slippage-wise, what your risk is, like especially when you're using a stop order, that's a big deal. When you're using a stop order, then your slippage can be a few more ticks than you would have on the E-minis, especially when the market is a little bit slower. And it's more noticeable if you're trading the micro Dow or the micro Russell. Those two actually have a little bit more slippage. The micro NQ and the micro ES, those are pretty minimal. You don't really have much slippage on that, except for sometimes outside of market hours. With a limit order, I haven't had a problem getting filled. So when you are looking at entering a trade, if you're looking at entering a trade, you've got your bid or your ask. A lot of times, people will go and they will just enter all of their trades using market orders. But if you're buying something, I will usually do a buy on the ask and a sell on the bid. So that way, I'm not getting the best side of the spread, but I'm most likely to get filled. And if the market moves quickly, that's the only time I wouldn't get filled doing that. Pretty much regardless, I'm going to get filled doing that. Well, unless I have a lot of contracts and it's outside of regular market hours. During regular market hours, that is not much of a problem. All right, so you guys, I'm made a mistake here on our prices on this, but you know what? Points exactly the same, 15 points. Let's go forward here. So when you're looking at our setups here, let's review. So first of all, when you're looking at 3 contracts on the NQ, you're going to be looking at stops that are going to be really, really substantial. Versus the MNQ, you're going to have a much smaller stop, and you're going to have that opportunity to adjust your trade as the trades are moving. So it's not going to be as much of an emotional hurdle as it's going to be if you're trading the full E-mini contracts. So let's look at this here as a difference. We've got some vastly different methodologies for our core strategies when you're taking them. So core strategies, again, I've got to fix that. But anyways, you're going to have the channel break here. And just looking for one-to-one, again, they say use the entire high of the pullback. And I'm going to tell you, use the first main impulse moves in the original rally, and then use that measured move as the target, using the channel break as the entry. So this one, you got less than one-to-one return to what you're risking. Over here, you'd be able to get a little bit more than one-to-one, but the problem is that it doesn't actually hit the stop. So both of those methodologies are not ideal for trading a cup with handle. Instead, what you want to look for are the smaller pullbacks, the smaller breakouts out of that channel. So when you get the smaller breakout, you're going to have a lot more gain locked in compared to what your stop is. So your NQ, your MNQ, every point is $2. Your MES, every point is $5. Your Dow, every point is 50 cents. And your Russell, you are at $5. If I enter the smaller pullbacks, am I entering usually a limit order usually? Yeah, usually I will be. Usually I'm going to use the limit orders for most of my entries, building most of my entries. And I haven't had much of a problem getting filled on those. Again, what I'm doing though is I am using my fill where I'm taking the worst side of the spread. So if your bid is, say, 72.50 and your ask is 72.50.5 and I'm buying, then I'm buying at 72.50.5. If I'm selling, then I'm selling at 72.50. So I'm going to give up that spread in order to get filled. So the big difference comes down to managing the trade and the difference of what you're going to have on your return compared to what your risk is on the trade. All right, you guys, so I know you got a lot of questions, so I'm going to stick around here. So you guys want to learn more about my trading methodology and how I trade, some of those details that go into my trading. I've got a book that I've written. It has won numerous awards over the years, and you guys can pick up an ebook copy of it. So I have the ebook available right now for just $7, and it basically goes into details on getting started and how to analyze your own trades. So when I first started, I was taught things like buy a pullback into a 20-period moving average. And kind of left with that. You know, look for a 5 to 7 bar pullback into a 20-period moving average. That just sticks out in my mind. That was like the core concept, core strategy I was first taught. And I quickly realized that if I did that, over time, I was losing a lot of money, especially because I was using those core channel breakout methods like I showed you guys on the cup with handle. Those first two methods for the cup with handle, that's what I was taught for buying those bull flags. So what I ended up doing instead was looking at, hey, which setups are failing? What do these failing setups have in common? What do the winning setups have in common? And I developed a trading system based upon that, where I basically look at the building blocks that go into creating a trade. So I looked at things like momentum, like the two-wave count, both of those things that we talked about here today, where they impact the success of the trade. So if you look at the momentum here, see the momentum on the setup that worked compared to the momentum on the pretend setup that would have failed? The momentum slowed there. That increased my chances that it was going to fail. As soon as I would see that happen, I would know that my odds of that strategy working were no longer going to be as good. When it drops quickly back to the previous lows, this is starting to become more of a guarantee that it's not going to work. In order for that to still work, what it would have to do is basically shift here, kind of ride that upper channel here. And you'll see things that will do that, that will come up into the resistance point, and then they'll just kind of slip down it. They'll slide down it, and then they will break higher again. But it takes that additional shift in momentum again to get that buying to come back in. Yes, you can reach me, you guys, at toni@tonihansen.com. As long as you can spell my name properly, you can reach me.
Well, I would like to give a special thank you to Toni Hansen for a great presentation. Everyone in attendance here today will receive an on-demand recording of today's event. Please keep an eye out for that email. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in these events, we hope you will attend them on a regular basis. We would like to remind you the information provided in this was that of Toni Hansen and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spend with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us at NinjaTrader Ecosystem.
And thanks for having me, Tiffany.
Thank you so much, Toni.